I'd like to start by telling about a common error that people make when doing calculations like the Mary assignment, so the Mary question. And you recall there's proceeds, right? Remember what the proceeds are? How much?
6.2 million?
And then there's a adjusted cost base for shares. How much is that? Let's say for sake of discussion, it's $3 million. So how much is her capital gain?
3.2.
And then a whole bunch of things happen, like does she qualify for the capital gain exemption, all that kind of stuff. And then what we're trying to get at though is to figure out what her net cash proceeds are. So they start out as being $6.2 million minus her adjusted cost base. That's the mistake. A lot of people think that somehow the adjusted cost base has some relevance to the cash proceeds she receives. It's got no relevance. It only has relevance to figuring out how much her tax is. Because her net proceeds is 6.2 minus repaying her bank loan, cash transaction, minus paying taxes, cash transaction, equals her net proceeds, compared to whatever it is she needs, 4.5 or something like that. Do not put the adjusted cost base into the calculation of her net cash proceeds. It only belongs in a tax calculation, which is how much is her capital gain and taxable income and all that kind of stuff. Any questions on that? Common error, even made by practitioners. ACB is only a tax deal. It's got nothing to do with her cash proceeds. The Chapter 9 survey, thank you to the students who completed that. 60% of students who completed that survey said that they have issues about attribution of income from a gift to a minor child. Does anybody have any question they'd like to ask me about that right now, or if you prefer after class, that's fine too? That was the only thing. The only thing that stuck out sort of like a sore thumb on Chapter 9 was that particular issue. We did have a recap of it last class, and I think it did show up in the 40 or so minutes of video that we did have before the battery ran out, so feel free to revisit that if you need to, and come and see me if you have any questions. So we've gone through 8 or 9, 10 chapters or something, just talking about the calculation of net income. And today we're going to calculate tax, and it's only going to take 1/2 of a lecture. The calculation of tax is actually relatively straightforward. It's just sort of formulas like multiply and add and subtract. It's the calculation of net income and taxable income that obviously takes a lot more time. So here we go. Let's look at the tax calculation. Please go to page 377. First and most important part, you're writing the final exam. Where do we find all the tax rates? Please grab your Income Tax Act. And what you want is called tax reference tables, which is on page 29, that's XXIX. So as you've learned in economics, we have a progressive tax system. The bottom rate is 15%, the top rate is 29%. Those brackets that you see, so 15% up to 42,707. Those are non-round numbers. It's not, exactly $42,000 or something, because these change every year based on inflation. So there's actually a calculation in the Income Tax Act where it says that based on the CPI, the Consumer Price Index, for some period of time, it could be the first 9 months of the calendar year, the indexing, we call it, changes for the year after, and therefore we get brackets that are these non-round numbers. So for 2012, these are the brackets. For 2013, the brackets will go up slightly. Interestingly, it's the same thing with the provinces, except there are, I believe, 2 provinces where the brackets do not change, and Manitoba, sadly, is one of them. If you look at these Manitoba brackets, up to $31,000, that's a round number, hasn't changed in years, etc., etc. Once about every 3 or 4 years, they make a step change. But honestly, a lot of people are lobbying for the government, please, to make it a CPI change every year. The reason is that this is important is people's income goes up, salaries go up, for example, with inflation. But if the tax brackets don't go up, we actually end up paying more tax. You can figure it out mathematically. So we call it bracket creep. And unfortunately, Manitoba is one of, I think it is only 2 provinces that has that problem. So when the Manitoba the Manitoba budget comes out, which will probably be sometime in April, watch in the newspaper, they always talk about this bracket creep. And editorial writers and so on complain about it, and it's a valid complaint. And maybe we'll get lucky this year, maybe this will be the year that we'll have a step change in the brackets and therefore not suffer this inflation-induced tax increase. So the tax rates themselves are pretty straightforward. There are only 4 brackets. The rest of this discussion will be about credits. Discussion on the credits starts on page 379. And if you're following along in the Income Tax Act, turn the page to page 31, so XXXI. These credits are almost all calculated based on 15%. So for example, the first credit, called the basic credit, everybody gets that. Basic personal credit, $10,822 there. My actual tax savings is $10,822 times 15%, which is around $1,600 and some dollars. So each of these sort of has a base, let's call it. In this case, the base for the basic credit is $10,822. These credits used to be deductions. Back in the day, instead of claiming a credit at a 15% rate, I would instead get to claim a credit at whatever my marginal tax rate was. And if my marginal tax rate was 29%, my reduction in taxes would be $10,822 times 29%. Somebody realized that that didn't provide similar treatment across all taxpayers. So they said, let's make it into a credit, and let's pick a rate at which the credit will apply, and the rate that they picked happens to be the lowest marginal tax credit. So regardless what bracket you fall into, regardless what your income is, your basic credit is $10,822 times 15%. That is the case with all of these except for a couple of small exceptions which I will speak about, particularly the charitable donation credit when we get there. Bottom of page 379, all individuals get a basic credit of $1623, which is $10,822 times 15%. You've seen in a few examples, particularly when we talk about loss carryovers, when we're carrying losses from one year to another, sometimes we're reducing our taxable income to zero. Actually, the ideal is to reduce our taxable income to $10,822 because the credit looks after all of the tax on that amount. Give you an example of that.
But if you have 10,822, sorry, if your spouse has 10,822, can you still claim the spouse limit?
We're not there yet.
Okay.
If you look at page 370, so that's an example that talks about moving losses from one year to another. And there's an asterisk there, and the asterisk says, because of a tax credit available to all individuals, there's no federal tax on approximately the first $10,822. Well, exactly the first $10,822 in 2012 of taxable income. Consequently, in this example, the taxpayer should reduce the loss carryover claim by that amount, thereby leaving taxable income in the year of $10,822. And then the tax on that at 15%, because we're in the lowest bracket, gets wiped out by the individual credit. So generally speaking, anytime you see a question where you've got discretionary deductions for an individual, like for example claiming losses or even capital cost allowance and that type of thing, those deductions are wasted if we reduce our income below $10,822 because the credit would have wiped out the tax anyway. Page 380. Individuals with a spouse, they don't even need to be supporting them and they don't even need to be dependent. You might see the word supporting and the word dependent. Just individuals with a spouse get to claim a credit for the spouse. The way that's calculated is we start with $10,822 for the spouse, and that credit gets reduced by 15% of the spouse's net income. So let's say, for example, my wife has $50,000 worth of income, and I have $20,000, and she's going to claim me as a dependent spouse. She cannot claim anything for me because my income is higher than $10,822. If my income were $5,000, she would claim for me $10,822 minus $5,000 equals $5,822 times 15%. On page 31 in that table, do you see the word net income threshold after the spouse credit? Net income threshold means, first of all, anytime you see the word threshold, there's going to be a subtraction of some kind. In this case, the threshold is shown as a dash. That means 0. So if the spouse's income is higher than 0, we have to subtract the spouse's income from $10,822. So in the example I just gave, where my income is $20,000, subtract that from $10,822, we have no basis, my wife has no basis on which to claim the credit. Or if my income is $5,000, my net income, subtract that from $10,822 and we do the math that I just did. So a threshold of 0 means that we subtract the entire net income of the so-called dependent spouse from $10,822. So to answer Cindy's question, if my spouse has no income I can claim 10-8-22 for myself as the basic credit, and I can claim 10-8-22 spousal credit. 10-8-22 minus 0 is 10-8-22 times 15%. Now you see that a whole whack of these credits are coming up at 15%. As I mentioned on the assignment in the instructions, don't waste time, this one times 15%, this one times 50%. If you want, just add them all up and multiply them by 15% at the bottom.
So when you just said that, for that instance, you said if my spouse's income is 5,000.
Right, and I'm sorry,
Or let's say it's 0, sorry. Let's
my
say it's 0.
income, sure.
So you could go 10,822 minus 0 times 15%, claim that for your wife, on top of claiming your basic tax credit. Is that what you're saying, that you could?
No, and let me write it down to make sure we've got the example right. So this is my wife. Her net income is $50,000. My net income is $5,000. So on her tax return, she's claiming the spousal credit for me. She claims 10,822 minus my net income, gives us 5,822, and her actual credit is times 15%. Whatever that is, it's probably around $800 or something, give or take. Is that okay?
But that's only in instances when it's less than 10,822.
If my income were $20,000 minus 10,822 minus 20,000 is 0, therefore no spousal credit on her tax return.
But my question was, if the spouse that you want to claim the spouse credit for has only that instance capital gains and losses and gets their income down to 10,822, then their spouse can't claim them
Correct.
for
So
spousal credit.
that's right. So if good tax planning, for me, let's say, gets my income down to 10,822, that's a good thing. Therefore, all of my income gets wiped out by the individual credit. But my spouse does not get to claim a credit for me because she subtracts my net income from 10,822 to get 0. So no spouse credit on her return. Yes?
Sorry, what did you mean when you said with net income 10,822 it wipes out, you said something about wiping out?
It wipes out her ability to claim me as a dependent. She cannot claim any spouse credit because it got,
But the me would still be able to claim the basic credit? Right?
correct.
Okay.
So I have 10,822 of income, net income, I can claim the basic credit. Sorry, taxable income. Credit is based on my taxable income. Yes?
If both spouses have income that is less than 10,000, can you choose the
What happens if both spouses have income of, say, $8,000? Then it doesn't matter. The individual credit would have wiped out all of their tax, and they don't even need to look at the spousal credit. What if both spouses have $80,000 of income?
Neither of them can claim it, so it's immaterial.
Neither of them can claim the spouse credit. Of course, they can both claim the basic credit, the individual credit. But neither of them can claim the spouse credit because both of their spouses, each other has net income higher than 10,822. This is important. Page 380, second paragraph. Single parent households. In some case, an individual is unmarried but supports another person who lives with him or her, such as a child or other relative. A credit, sometimes called the equivalent to spouse credit, is available and is exactly the same as a spouse credit. This normally applies to a dependent child who is under the age of 18 or over 18 and dependent by reason of infirmity. So in this case, my wife is widowed, which means I'm dead, and she has a minor child at home. She can claim the minor child as if the minor child were a spouse. Same deal with the threshold. Subtract the dependent child's net income and then figure out how much she can claim.
The part that says that the dependent can also be a parent or grandparent regardless of age, does that imply that the parent or grandparent doesn't have to be infirm? Like,
That's
is-
correct.
Oh, okay.
Yeah, the parent or grandparent doesn't have to be infirm. That's actually, I've seen this happen where, well, a friend of mine right now, her mother moved in with her and she'll be there for the duration. And her own children are all adults and her husband makes more than 1022. I bet you the granny doesn't make more than this, and therefore my friend can claim the grandmother on my friend's tax return.
And can either of them claim it, or does it have to be the wife whose mother is living with,
I'm
like,
pretty sure that either of them can claim it, therefore,
the one with the higher tax, the higher income would claim it, or
it doesn't matter. It doesn't matter because the credit is based on
Set.
15%, yeah.
Okay,
The only time it would matter is if my own income were less than $21,644.
okay,
Then I'd put it on the other spouse's return because the other spouse can swallow both credits.
oh, okay.
Child credit. By the way, we're not going to go through all these. I'm actually going to give you a list of the ones I don't need you to know. So we're just going to hit the highlights today, and the rest you don't need to know. Child credit you need to know. Back to the table. $2,191 for each minor child. And that's all I need you to know. I don't need you to know about all that stuff like any unused credit can be transferred to the other parent, blah, blah, blah. Just need you to know 2191 times 15% is 329. Now I'm going to start crossing things out. Yes?
Sorry, just a quick question. If you were a single parent, would you be able to claim both the equivalent spouse if you were supporting a child under 18 and the child credit?
No. Cross out infirm dependents, caregiver, family caregiver. Age amount. Back to the table, it says age 65 or over, 6720, and then it says net income threshold again. The net income threshold is $33,884. That means that your calculation is 6720 minus 15%, the same 15% that the credit is based on. 15% of the over 65 person's net income, higher than that threshold, 33,884. So let's say I'm 70 years old, and and I'm thinking, yes, I qualify for another tax credit. And let's use the example in the textbook, bottom of page 380. Let's say I've got $40,000 worth of income. So in addition to claiming my basic personal, and in addition to claiming maybe a spouse credit for my wife, I take $40,000 minus 33 something, multiply that by 15%, subtract that from 6720, times 15%. Sure. Got the bottom of page 380?
Oh, is it in 380? Sorry.
Yep.
But it's scratched out, right?
No. Age amount I need you to know.
Okay, sorry. Thanks.
Let's do the math with this $78,000 number on page 381. So what this says is this credit is zeroed if our income reaches $78,000. Let's test that math. I don't have a calculator out, so I'll rely on somebody else. So I take 78.
It's true.
Good. What do I subtract?
The 33,884, you times,
How much is that?
44,800,
times that by 50%. So that's
which is
67.
six, yeah, 670, 20.
So if my net income is this much,
And then that's what you subtract from 6720.
right, like this.
Yeah. Yeah,
So this goes up here.
yes.
Good. You okay with that?
And if the answer wasn't zero, you would multiply that by 15%?
Right.
Correct. So if this answer was
$10.
$10, let's say, because maybe this is only 38,000. What we're calculating here is the base.
Do they let you have a credit that's less than, they seem to have something about a $2 number. I don't know if that's just, they don't give back checks for $2, or is there a, like, if your credit ends up being $1.67, is that what you claim?
These are so-called non-refundable tax credits. If these credits put you into a negative position, it's not like they owe you tax. So you can't sort of go into a zero position where your credit means that they owe you. So we call that a non-refundable tax credit.
No, but my question is, if it comes to a little number.
I'm about to answer your question.
Okay,
Separately, Revenue Canada, just as a matter of policy, doesn't demand from you a balance payable of less than $2. It might actually be $3 now. And they don't pay a refund of less than $2 or $3 just because the processing charges are too high. But that's a whole separate issue. It's got nothing to do with these non-refundable credits.
so if you come to $1.26, that's what you claim?
So if you come to $1.26 of tax payable,
Of a credit? No, of when you're calculating your credit.
no, if you come down to anything, or $1.26 positive,
Yeah,
that's
of
what
a
you claim.
credit. You would claim $1.26 as a credit for that,
Yes.
okay?
So for example, my spousal credit or my age credit?
Age credit.
Sure.
Yeah. Okay.
The cents don't really count. The cents don't really count.
You know, it's funny, when I do a tax return, I was doing my family's tax returns this week, and I truncate them. Like, some people round them. Like, there's a slip for $6.92. I just put in $6. But in both ways, like if I have a deduction, I just put in $6 as well. Just, I don't believe in pennies.
Neither does the CRA.
Neither does the CRA, that's right. And they've never chased me on it, and I'm sure that they owe me or I owe them $10 over my lifetime, but we're all good. So that was the age credit, and that one has a threshold. Pension credit, I do need you to know that one. $2,000 of qualified pension income. And pension income in this context is like a periodic payment. If I just go and take out $50,000 out of my RIF, I do not qualify for this. I only qualify for this if money's being paid out of my RIF on an annual basis, according to the formula in the Income Tax Act, which I think takes out about 7% a year. Or if I'm getting paid a life annuity, some other type of periodic payment. There's a sentence that starts, when the annuitant is under 65 years of age. You can cross out the rest of that paragraph. I just need you to know how the pension credit applies to people 65 and older. So again, 65 and older is all I need from you, and these pension payments we speak of does not include lump sum payments or lump sum withdrawals. Employment credit. Very straightforward, $1,095. It's referred to right in the middle on page 31 table. Everybody who earns employment income gets that. You can cross out the following: adoption expenses, public transit pass, although I hope you're all using that one. I happen to believe a lot in public transit, and so I think that's a good credit. Children's fitness credit, cross that out, although I do believe in fitness. Children's arts tax credit, and I do believe in art. I would like you to know about the first-time homebuyers credit. I don't want you to know about volunteer firefighters. Charitable donations. This one's very interesting. So there's a credit of 15% on the first $200, and then a larger credit on the remainder, 29%. So we go from the lowest tax bracket to the highest tax bracket. This is a really big subsidy that the government provides for the benefit of registered charities. If you're looking at the table, so it's pretty straightforward. It's at the bottom of that page. It's pretty clear. Credit rate on the first $200, credit rate on the balance. Let's do some quick math. I made $1,000 worth of donations in the year. How much is my credit?
$150. Oh. A lot.
$1,000. $1,000 charitable.
$292.
First $200 is,
30.
and the next $800 at 29%.
Isn't it 292?
230.
Total, it's 292 though?
800 times 129 is $232.
Plus the $30.
Yeah, that gives you 262.
Everybody okay with that? So two-stage calculation. Got two spouses. Each of them makes $200
In income?
in charitable donations.
Oh. Thanks. Okay.
CRA allows, combine them on one spouse's tax return. My wife loves it when I give this to her. So the second 200 is at 29%, that's like $58. Total of $88 as opposed to $60.
And either spouse can claim them.
And either spouse can claim it. It doesn't have to be like the lower income spouse or the higher income spouse or whatever. At home at our place, I put them on whoever has the largest balance payable to CRA gets all of the deductions. Gets all of the donation credit. Yes?
So oftentimes, when you're in like a tax situation, a lot of people will try to make donations, right? Like I hear that through making donations, that's one of the key ways that people, or one of the key actions that people are taking on
To reduce taxes.
Yeah, to reduce taxes. But,
Yep.
okay, so you can do up to 75% of your net income is what it says in here, right?
Correct.
So doing 75%, that's a lot though. That almost takes away from their living money.
Well, it depends how much you make.
Okay, that's a good point.
I'm guessing
Make
Bill
like
Gates could
500
give away 75%, wouldn't hurt him too much.
But if you make 125 and you give away 75% of that,
There are people who make that much money that they can give away 75%. The other part is, donations in excess of the limit can be carried forward for 5 taxation years.
But can't you carry forward your donations in any year? Like if you don't claim them this year, can you not claim them next year regardless of whether it was the limit or not?
What's the benefit to claim them in a later year?
Well, there wouldn't be one, but if you lost a slip and you found it in a subsequent year, you could claim it, correct?
You can combine last year and get the full 29%.
I'd rather refile last year's tax return and, because
You can, right?
if it does take me over the 200, I'll get more for it. And I think they'll pay me interest also if I add it to last year's tax return.
If you refile, they'll pay you interest if you haven't, really? You
Yeah, I'm
haven't
pretty
paid
sure
your
they do,
refund?
yeah.
That's very sly.
Well, the interest rate is 3%, so.
True.
So if, there is no benefit to defer a credit like this because it's going to be the same amount of credit next year and the year after. It doesn't have anything to do with tax rates. It's always going to be maximum 29%. So it's better for me to claim my credits, but if they happen to be higher than 75% of my net income, I can carry them forward for up to 5 years. Yes?
Well, wouldn't it be a benefit, like let's say you just made $50 donation this year, and the next year you made $300 donation, you're better off to save for that year.
No, you can't combine years like that. No. That's why the donation slips always have the year on them.
You
And-
sure about that? You sure about that? I'm not sure. I'm pretty sure I've seen a lot of people try and claim prior year.
I've seen a lot of people try to do a lot of things. They can claim a prior year deduction, but I don't think it's going to increase their amount for this year into the 29% credit. It's a good try though. Honestly, once in a while, so it's 2012, right? I'm doing 2012 tax return. And maybe I've made a donation in 2013 already, and that one will go into the wrong pile, and I'll claim it by mistake. And I've always had it disallowed. It's unbelievable how much they look at donations. Like even a $20 slip for diabetes or something, and it comes back to me. You should not have claimed that, and they're absolutely right. So I actually watch that like a hawk. I look at every slip, and unfortunately they're not the same format, right? So you have to read them pretty carefully to see exactly what year it's for. Yes?
A little off topic, but like, what is like the worst thing you've seen?
Worst thing I've seen?
Yeah,
For charities or other
or
things?
just in general.
I'll give you charities first, then I'll talk about medical expenses, which is coming up. There are actually a lot of tax scams out there about charities where people are marking, like you buy, say, a piece of art, I'm sorry?
Or the medicine?
Or medicine or something like that, and donate it to a charity at a marked up price.
Fair
So-
market value.
Maybe you bought it for $2,000 and its supposed fair market value is $5,000, and you get a donation receipt for $5,000. You probably also have a $3,000 profit that you didn't report, which you should have. And you really have to be careful that that fair market value is really the right fair market value. If CRA comes back and finds out that the fair market value was really $2,100, they're going to disallow a large part of your donation credit. So if you Google CRA donation credit, you'll get a whole bunch of publications by CRA that say that they're watching these things like a hawk, and the penalty is that you can get your credit disallowed, which is not good, and you're out of some money, right? Because you paid $2,000 for the art or the medicine or something, and the registered charity can get its registration yanked, which is a really harsh thing on charities. They work very hard to get that registration, and they don't want to have that deregistered. Remind me, please, of medical expense when we get there. I'll tell you that one. Medical expenses. Cosmetic surgery for breast augmentation. I had to set that one aside. It actually wasn't mine, but somebody in the office said, I don't know what to do with this. I got this, they sent me this invoice, and I guess they want me to claim it as a medical expense. And we actually researched it and found out that it wasn't allowable because it's cosmetic. A breast reduction, particularly for clinical reasons, would have been a medical expense, but this one wasn't, so we were not able to deduct it or claim a credit for it. We had to explain it to an unhappy client.
Well, they couldn't have been that unhappy.
Didn't ask.
It says medical here, but does that include like dental and physio and?
Dental and physio and foot
Counseling?
doctor, counseling, chiropractic. It's a huge list. The list goes on for pages and pages.
Oh, there's an actual list?
There's several Revenue Canada publications. Actually, this is an important thing. If you have any doubts about stuff like this, my mother has celiac disease. I think they recently added gluten-free food as a medical expense.
Really?
Yeah, like there is a huge list. Yes.
Oh, I was just reading that one today, and you can claim the difference between like what it costs.
Maybe that's what it is. Yeah.
Free compared to just like regular.
Right. So if you buy flour, for example, she buys exotic flour of some kind, and if her bag of flour costs $10, but a regular bag of wheat flour costs $2, she can claim the $8. Luckily for me, she doesn't care about that stuff because I'd be going through like a whack of Safeway bills, and I prefer not to do that. But seriously, there are a lot of, like my wife needs shoe implants for something, and that's claimable. Braces. Two of my kids needed braces. Now this one is interesting as regards the year. You're actually allowed to use any 12-month period ending in the year. So here you can actually do some planning by looking at what you've got in the year and what you expect to have early into the next year. So maybe you don't want to claim all of your stuff this year. Maybe you want to move some of it into 2013 because you're expecting a big 2013 expense, let's say in July of 2013. You can go from July of 2013 all the way back to August of 2012 and claim that 12-month period on your 2013 tax return. So that's one where you are able to sort of play around between years, and it's any 12-month period ending in the year. Yes?
When do you have to make that decision? Like, can you, like, it seems like it should be kind of every year you have the same 12-month period, but how do you kind of decide that?
You sort of decide it just when you're doing your tax return. So like right now, people are doing the 2012 return. And I mean, I used to have this discussion with my wife. I'd say in March when I'm doing the return, what's the braces situation? Like, do we need another retainer in the fall or what have you? Because maybe we just paid for a retainer in November, and I'd sort of like to lump those together. And the reason for that is because you're only allowed to claim your medical expenses minus 3% of your net income. So depending on what your net income is, you want to, just like with the charitable, you want to smash them all together. Let's see how the math works and you'll see it.
But again, either spouse can claim it, right?
And either spouse can claim it. In fact, you want the spouse with the lower net income to claim it. Because the formula is,
Because the threshold is lower.
there's a threshold and the threshold is lower. So for example, just like it says in the book here, if I've got net income of 40,000, times 3%, I can only claim medical higher than $1,200. So if my medical is $2,000, and this is myself, my wife, and all my under 18 children. If it's $2,000 in total, I can claim $800 times 15%. Now, if my wife,
What was the 2,000? Sorry?
2,000 is my actual medical
Oh,
expenses.
Yep.
Yep. Prescription drugs, et cetera, et cetera. Again, there's a giant list. If you need to see it for yourself or a relative, let me know and I'll find it for you. If my wife's income was $30,000, this math would be 900. And we could claim 1,100 times 15%. Yes?
Can you claim braces and orthodontics in your tax, when filing taxes? Because isn't that considered cosmetics?
Cosmetics aren't allowed, but my kids, this is the truth, had a problem where food was getting in and causing infection or could have or something, and so it was partly a periodontic, I think, issue as well as cosmetics. But stuff purely for cosmetics is not claimable.
So is it assumed that when kids get braces that it is medically related, or would that be considered cosmetic with our kids? If they didn't have a gum issue, or if there were no reference to any medical issues?
I don't think CRA is. How
I-
would they
I've
be able
actually-
to differentiate why you got the braces?
You know, now that you mentioned it, I don't actually recall seeing, for example, an invoice that said this was necessary for medical reasons. And I've never heard of anybody's braces expense being disallowed.
Okay,
So
thanks.
there it is. Again, if you're interested in the real rules, Revenue Canada's got, I think they actually call it an interpretation bulletin. And it goes on for probably 8 pages. It is a huge list, and it gets added to every year. Let me just finish this one point. So we did the math at a $40,000 calculation and a $30,000 calculation. We're going to put them on my wife's tax return because her income is $30,000. Therefore, we will get a higher credit. If both of our incomes were $90,000, which would be $2,700,
You can't claim anything. Because it's the excess of 2,700 and your expenses aren't higher than that, right?
that's right. But there's good news. This amount maxes out at $2,109. Don't ask me why $2,109, it's one of those inflation deals instead. Inflation deals again. So if, let's say the braces was $12,000, I wouldn't have to subtract 12,000 minus 2,700. It would be 12,000 times 2,109, even if my income were $900,000. So for high income earners, this is a rare case where they get penalized only to an extent and no further. And where it says that is on page 382. Taxpayers with net income above $70,300 can deduct all medical expenses above $2,109. Now, when you're looking in the Act, I'll be back to you in a second. It says medical expense threshold, $2,109. So please make a note of that. And know that a threshold is something you have to subtract from something. That's this case.
But that's a bit misleading. Like if you only looked at this, it doesn't tell you that if 3% of your income was lower than 2,109.
Then write it down in your book.
I did, but I'm just saying.
We'll find out what states.
Eyeglasses, absolutely. Yeah, glasses are clearly creditable here. Yes?
So, if the 90,000 times 3% is 2,700, because then the 90,000 is above 7,300, you would then subtract 2,109 from 2,700 and multiply that by 15%?
Correct. So if you got 90,000 of income, you don't deduct 2,700, you deduct 2,109 off of this, and then multiply that net times 15%.
And eyeglasses are only deductible in the year that you purchase them, right?
Eyeglasses are deductible only in the year that you purchase them, but again, it's any period, any 12-month period ending in the year. So you could carry them to next year if you wanted to select a 12-month period into next year. Yes?
What if you, like, I'm still under my dad for health insurance, so that covers, I don't know, whatever percentage. Is it only what you actually pay, or is it the whole?
It's only what you actually pay, so if health insurance covers a part of it, you have to subtract that off of the gross cost. My wife's a teacher, and luckily for us, she has like Blue Cross coverage, so I had to go through every bill and sort of match it up with the corresponding partial reimbursement from Blue Cross. It's more trouble, obviously, to do the tax return, but I love having that partial reimbursement. That beats any tax advantage I'm getting from claiming this. Disability. I do want you to know about that one. And it's referred to in the table about a third of the way down, child adoption disability. And it's $7,546 times 15%. The reason I want you to know about this is actually in case you know anybody who can qualify. If a person is unable to do certain things for themselves, like if they have trouble getting dressed, for example, or using the washroom or that type of thing, it's anything that sort of impairs your normal routine because of a health issue. You get to claim this. There are actually people who, as their full business, seek out and claim this for people and get tax refunds for them. Because I think CRA will allow you to go back 5 or 10 years on this. And sometimes the refunds are substantial. So I've seen people qualify for $5,000 at a time plus interest going back all those years. So it is something worth mentioning to parents or grandparents in case that they're able to claim this. Education amount, tuition fees, textbook amount. I do want you to know about that. not just for this course, but for yourselves as well. This is actually a fairly straightforward thing. Obviously, your tuition counts, and as well an additional amount per month of full-time attendance. And there's also part-time credit, which I don't need you to know about, but the full-time one I do. And again, it's in this helpful table at $465 per month. And again, it's times 15%. And there's an ability to transfer credits to your parents, which is referred to on the top of page 383. And that's always made me happy in March and April.
Or your spouse.
Or your spouse. If your spouse is going to school, you can transfer that. And does that make somebody happy at your house?
It makes my husband very happy
Awesome.
that something's happening because I'm spending this money.
Excuse me.
Yes.
If I have government pays part of my tuition fee, I need to take that.
Yes. So it's only your net tuition fees. It's just like health insurance. You take your gross and you subtract the part that somebody else is paying for.
I don't know if this would fall into this particular education amount, but what about those situations where if you send your child to a religious private school and then that's a charitable, like, is that, can you explain that to me? Because oftentimes I'll hear things like 60% or 80%.
Anybody know what the treatment is of private school tuition, faith-based or otherwise? Yes?
I think it's just a charity, isn't it? It's just treated as, I'm wrong.
No, it's
I'm
not.
But you get a tax deductible receipt in the mail before, right?
But it's not for the whole amount of the tuition. My son goes to St. Paul's. We pay about $7,000 for him per year to go. We get a tax receipt for about half of that.
So then is it 15% on top of that, or?
So, first of all, private school tuition is not creditable. I used to say deductible, creditable. You cannot claim a credit for private school tuition. You can only claim a credit for post-secondary. Individuals who attend university, college, or other certified post-secondary institution can claim a credit of 15% of tuition fees paid. St. Paul's High School and most other private schools have a charitable donation number. They're registered charities, and they decide somehow that part of the tuition is not a tuition, it's a donation. So they issue a donation receipt for part of that.
Wait, so I was right?
They actually take that money and put it towards their bursary fund, so it is actually a donation.
Oh, interesting. They actually take that money and put it to the bursary fund, so it is actually a donation. That's good. Yes?
I remember last year when I was doing my taxes, there was a box for an instant rebate on your tuition for, I think it's like between 3% and 5%. Is that one only federally, or is that one a provincial thing?
That's a provincial thing, and what they're trying to do there is encourage people to stay in Manitoba after they graduate.
But that's the 60% one. This one is an instant one for the current year's tuition fees. Okay?
I thought it's a an advance on the 60% one, but I could be wrong.
Yeah.
Yeah, it just takes from the same pool, so either you get more later or.
Yeah, because people are saying, oh yeah, great, so I gotta wait till, I'm here for X years after I graduate, can't you float me a few bucks today? So that I think is what they've done, and that'll take off of whatever you're entitled to later.
And you give it back if you leave. Do you give it
I
back?
think you have to give it back if you leave, yeah.
Yeah, you do actually.
Yeah, and how would they know if you leave? Well, you have to give your address when you file your tax return, and if your new address is in Saskatchewan, let's say, then it is CRA who administers tax returns for the entire country for all the provinces. So CRA would say, oh, I noticed you left Manitoba, you now live in Saskatchewan. They would tell Manitoba about that, and either Manitoba or CRA or somebody would send you a bill for the rebate that you should not have gotten. Interest on student loans. Now, this is on loans falling under the Canada Student Loan Program. It is not for lines of credit and such that a bank might offer you that's outside this program. Finally, CPP and EI. So these are withholdings that your employer takes off of your salary. Very common tricky tax question on exams looks like this. A person received a salary of $50,000 and their employer deducted CPP of $500 and employment insurance of $800. How much is the net income? These things are not deductible to arrive at net income or taxable income. They are creditable, which means we go back to the table, and for the employee's share and the employee's share only, we get a deduction, a credit of $2307 times 15% for CPP and $840 employment insurance times 15%.
Do we actually get that credit if we didn't contribute the maximum amount to CPP? Don't we get 15% of what we paid?
Yeah.
That's why it says max. We claim 15% of what we paid to a maximum of $2307 and $840.
Thank you.
And that, by the way, is the maximum that they can deduct from us. If you're at 2 workplaces and somebody deducts more from you, the government sends you a refund when you file your tax return. But if your income is income from business, self-employed person, you pay both halves of the CPP. You get a credit for the employee part, and you're allowed a deduction for the employer part. So I actually used to pay, still do, was it 2307?
Yeah.
So I pay $4,614. This is the employer, and this is the employee. This one is a credit. This credit. This one is a deduction on my tax return to arrive at my net income. Dividend tax credit. If you go back to chapter 7 for a second, please. And look at page 238. So when we looked at the integration principle, we were looking at hypothetical dividend tax credit rates. Now if you go back to page 383, we get the real ones. I'll make a deal with you. On the final exam, if you remember the gross ups, I'll tell you what the dividend tax credits are. How much is the gross up on public company dividends?
38%.
How much is the gross up on private company dividends?
25%.
That's all you need to know. I'll give you the rest. The dividend tax credit on public companies is 15% of the grossed up amount. So 15% of 138%. For private companies, it's 13 1/3% of the taxable amount. We call the public company dividends eligible. I'll explain why in a couple of chapters. And the non-public ones we call non-eligible. I'll explain why in a couple of chapters. Very important, this is 15% of the taxable amount, therefore 15% of 138%, not 15% of 100%. So I will give you, on the exam, I'll say the dividend tax credit you should use is 15% of the taxable amount. You need to know that that's the grossed up amount, and you need to know what the gross up is. Which you already do, so good for you. Other federal tax credits. I only want you to know about political contributions.
You don't want us to know about foreign tax credit?
No, because you already do. Because we took the foreign tax credit in an earlier chapter where we talked about, for example, if you earn $1,000 and they pay you $850 because they withheld 15% tax from you,
Yeah.
you have to report $1,000 in income, and then you claim a foreign tax credit of 15 against the tax you paid on 1,000, which might have been $450.
So if we remember it from that other example, we'll be able to calculate it if you want?
Precisely. You don't need to know anything more than what we talked about before.
Okay.
Political contributions. So charitable is on a 2-rate scale, 15 and 29%. Political contributions is on 3 rates. So the first 400 is 75%. The next 50%, pardon me, the next 350 is at 50%, and 1/3 on over 750. But there's a cap on the whole thing, which is $1,275. I cannot quickly find that in the tables, but I will undertake to do that and show you where they are.
You answered my question.
During campaigns, how is it beneficial for these companies, let's say, to such large donations?
Find out where the political is in the tables. Question is, how is it beneficial for corporations to do this if the thing gets maxed out at $1,200? The answer is this is for individuals. This is for individuals. But yeah, if you make $50,000 donation to some party, all you're getting, all the tax relief you're getting is this $1,275.
Can you create a fake corporation and how do that?
Question is, can you create a fake corporation? I will come and visit you in jail. Page 385, required ordering of tax credits for individuals. You can draw a line through that.
Oh, we don't need to know that?
No.
I will do that.
Required ordering of tax credits for individuals.
Hooray.
The reason that this exists is that if your income isn't large enough to use all your credits, there's an ordering where you use one credit, then another credit, then another credit, and there's reasons why that's important. I'll give you, in any example, a high enough taxable income that someone will get to use all their credits. Therefore, you do not have to worry about this. Provincial taxes. Draw a line through it. I honestly don't need you to know anything about provincial taxes. Take it from me that there's a sort of a parallel universe. Each province has progressive marginal rates, just like the feds. Each province has their own dividend tax credit, et cetera, et cetera. It would take twice as long to calculate on an exam the amount of provincial tax. I'll be satisfied if you can calculate the federal tax. Any questions on that? You might find interesting this sample calculation of tax on page 387. So please do go through it, but know that you're not responsible for the provincial tax. In fact, on my page 388, I've actually drawn lines through the provincial tax. On page 391, they have marginal tax rates. So by marginal rate, we mean the rate payable on each additional dollar. So if my income is $132,000 something and higher, my marginal tax rate is 29%. If my taxable income is only $15,000, what's my marginal tax rate? It's 15% because it is less than?
42,707.
Correct. So if my income falls into some bracket, that bracket is my marginal tax rate. So these are the top income brackets for various provinces. I find this interesting, but I find it a lot more interesting if it wasn't just the top rate. If I had some medium level of income like $50,000 or $60,000 and I lived in, say, Manitoba, I might like to know what my marginal tax rate is. So the Tax Facts and Figures publication that I put onto D2L today has some beautiful charts that you might want to look at and show to other people if they would find it helpful. For example, on page 8 of this thing, they've got a gorgeous schedule that goes through every level of taxable income and how much tax you would pay in the next dollar of salary or interest or dividends or capital gains or whatever. So you can go ahead and take a look at that. If it helps you do the assignment, I'm happy to provide it. It actually came out of the Online Learning Center for this textbook. That's another place you can find it if you don't take it off D2L.
That page 8 that you pointed us at, though, that table had, instead of brackets like this, inside the brackets they had like two amounts per bracket. So if the bracket was to 42,707, it was like in the middle there was a break. What was that?
In some cases, the province's brackets don't line up with the federal bracket. So for example, at some level of income like $40,000, it might be within the federal bracket, but you might have crossed a provincial bracket. And that's why there might be two tax rates inside one particular range.
Oh, okay.
That's the only reason.
That was confusing.
On Tuesday, we will continue with the alternative minimum tax, starting on page 392. Yes?
For the assignment on D2L, is it currently up to date with all corrections and stuff? Is it currently up to date with all corrections?
Yes, it is. The assignment is up to date with corrections. Hopefully those are the only ones, and thank you to the students who pointed them out to me.